Hey everyone, welcome back to Yasai State. If you are new here, make sure to subscribe and give a thumbs up if you find this video helpful. Today we are going to talk about an important concept in real estate finance, the debt service coverage ratio or DSCR. So whether you are an investor, a property owner or just looking to learn more about real estate finance, understanding DSCR is the key. It's one of the main way to assess if a property or business can meet its debt obligations. Let's start by defining DSCR. The debt service coverage ratio is a financial matrix that tells you how easily a company can meet its debt obligation using its operating income. To calculate DSCR, you take company's net operating income and divide it by total debt service, which includes both interest and principal payments. In simple terms, DSCR shows how many times a company can cover its debt obligations with income it generates from operations. Let us look at an example to make it clear. Suppose a company has a net operating income of 80 lakhs and it has to pay 15 lakhs in interest and 35 lakhs in principal every year. To calculate DSCR, we divide the net operating income by the debt service, that is 80 lakhs divided by 50 lakhs, which gives us a DSCR of 1.6. So the company has 1.6 times the income needed to cover its debt payment. This is a good sign because it shows the company has a cushion to cover unexpected expenses or fluctuations. A DSCR greater than 1, like the 1.6 we just calculated, means the company is generating enough income to comfortably cover its debt. It is making 60% more income than it needs to meet its debt obligations. In real estate, typically the lender want to see a DSCR of at least 1.25. This means the property has a buffer of 25% above its debt obligations. For riskier sector like industrial properties or hotel, DSCR may range from 1.3 to 1.5. So why does DSCR matter, especially in real estate? Well, DSCR is a key metrics for lender, investor, and property owners when assessing the risk of the property. Lender use DSCR to determine if the borrower can repay their loans. If the DSCR is too low, it indicates a high risk and the loan might not get repaid. High DSCR indicates that the property can handle unexpected expenses or fluctuation in rent, while a lower DSCR may indicate the property isn't stable. Now let's look at some key factors that influence DSCR. First, revenue stability. If a business has inconsistent or seasonal income, its ability to meet debt payments can vary. For example, a retail business may perform well during holiday season, but struggle in off-peak month, leading to fluctuating DSCR. Debt structure. The structure of your debt affect DSCR. Short-term debt with high interest rate requires large periodic payments, which can reduce your cash flow and lower DSCR. In contrast, long-term debt with lower interest payment make it easier to maintain a high DSCR. Third, operating expenses. Higher operating costs reduce your net operating income, which in turns lower DSCR. Effective cost control, like reducing unnecessary administrative cost, can improve your NOI and raise your DSCR. Fourth, economic and market condition. The overall economy and market condition can affect the company's revenue and expenses, which impact DSCR. For example, during a recession, consumer spending may drop, which can lead to lower sales and affecting the ability to meet debt obligations. A good cash flow management ensures that a company has enough liquidity to cover its debt service. Even if it's profitable on paper, poor cash flow, like having a lot of money tied up in unpaid invoices, can make it hard to pay debt obligation despite strong earnings. While DSCR is helpful metrics, it does have some limitations. Let's go over a few. First, accrual accounting. DSCR uses net operating income, which is based on accrual accounting. This means income is counted when it is earned, not when it's actually received. A company might have profit on paper but struggle to make debt payments if it has a lot of receivables or unsold inventories. Next, DSCR doesn't tell the whole story. DSCR doesn't give the full financial picture. It doesn't account for things like the capital structure of the company, how much debt it has compared to equity, or its cash reserves. A company might have a good DSCR but still face a problem if it's over leveraged. Third, DSCR only reflects a company's ability to make its debt obligation in short term. It doesn't consider long term profitability or sustainability of income. A company might have a strong DSCR now but could face financial trouble in future due to market condition or declining profitability. DSCR doesn't always account for market condition. A property might have a higher DSCR now, but if market demand drops, the company could still struggle with the debt payments. Keep in mind, the DSCR can vary depending on the industry. So it's important to know what's typical for your business or the business you are investing in. At the end of the day, DSCR is just one tool in your financial toolkit. Be sure to consider other financial ratio and look at market condition before making any big investment decisions. Thank you for watching. I hope this video helped you understand DSCR and why it is so important in real estate. If you have any questions or want us to dive into other topics, leave us a comment below. Don't forget to like and subscribe for more real estate tips. Thank you.